Hi, my name is Z with Optionality. Today we're going to take a look at a FOMC trade that I put on a couple of days ago where I made a massive profit, but more importantly, I think there was virtually no risk in this trade. For context, I am a professional options trader returning 25 to 50% on my portfolio every year using options. Let's begin. The idea is to take advantage of the options environment around the FOMC to maximize, to construct a trade where you can maximize your profit and minimize your risk. Well, what is the options environment around the FOMC? Generally, the FOMC happens on a Wednesday. And the 2 days before the Fed are generally low volume, quiet days where the market will kind of chop around, whipsaw, and that's because big institutional players are not putting in a lot of positions during those 2 days because they don't know what's going to happen during Fed Day. There's a lot of volatility on Fed Day. Now, options that are expiring on the day of the Fed will not drop until basically the announcement. And usually they will retain 75 to 80% of their value, and it will drop precipitously during the 2 hours of the announcement. So what does this mean? We want to be short options going into the FOMC, but we want to be long options during the FOMC because we know they're going to retain their value really well, but we know that the short options before that are likely to die on the vine because basically nothing's going to happen before then. And lastly, I combine that with a bullish bias going into the FOMC, and I will show you the chart of SPY, which is the instrument I traded, going up into the FOMC. The way I leverage this is a call diagonal. So a call diagonal is where you sell an option in an earlier expiration, and then you long an option in the back expiration. Now the distance between those expirations is something that you can play with. This is why I love the call diagonal. You can basically tailor the delta, how much bullish bias you want to put into the trade, and you can tailor how much data is in the trade by adjusting the strike prices and the distance between them in expiration and in strike. And this allows me to be short the low duration options, which is literally I shorted an option 1 day before the FOMC, and I longed the option the day of the FOMC, mostly because I saw that the relative difference in volatility in pricing between those options was not as great as what it should be, because there should be a ton more volatility or a ton more pricing in the FOMC option, but than the one before it. But that wasn't the case. So that's one thing I took advantage of. I used the call side because I was bullish. And let's see how this trade picked up. And this is the exact trade that I put on. So I bought 15 diagonals. So you'll see that I was long the 560s the day of the FOMC, which is September 18th, 2024, and was short the 559s the day before. Well, Z, why did you short one strike underneath? It's because I could have longed 560s as well. I would have had to pay probably like 20 to 25 cents more, and I was already getting a positive delta going into this trade, and therefore I didn't feel like paying 40% more for the trade when I was already getting a positive delta. And I knew it was going to be relatively positive delta throughout the whole duration of the trade, even if technically the risk of this trade is actually to the upside, where if SPY spikes through the 560 to 570, 580, then yes, maybe I would have taken a risk. But you'll see when I put the trade on, I mean, it was already an outsized move to the upside, and I still took no risk. So I was very happy to pay only 40 cents per contract as opposed to like 75 or 65 cents for this position. So let's take a look. So I got into this position on Wednesday. So the market in the morning kind of dropped precipitously for the first 2 hours, and it just started grinding up. And I put on the position right around here where it started breaking the high of day, where I knew for a fact that all these sellers that are down here are all absolutely wrong. So I wanted to get long. And I targeted the 560s and 559s. Because there was, there's all this consolidation around the whole number 560, and it kind of chopped around here. We were right around here when I put it on in the 550s. So, 10 points a week, that was a little bit above the expected move of the options of that week. So I thought that was a fair region to target. And you'll see that it kind of doesn't matter where exactly you put the strikes in nominal value for this particular trade, it matters a lot more what the distance between the strikes are. So, like I said, there's kind of three scenarios. The stock can go up, the stock can stay flat, and the stock can go down. And the reason why I thought this trade had no risk is because if the stock went up, I was going to make money because I was bullish. I had positive delta in the trade. Great. If the stock went sideways, I knew that the front expiration would expire worthless, and I knew there was going to be so much juice packed into the FOMC option that I was still going to be able to salvage some amount of money from the 560s. 40 cents, 50 cents. 50 cents, I would have made a profit. The other way I could have taken off, if the trade didn't pan out in my favor, what I could have done is I could have moved down the 559 strike down to like 558, 557, 556, depending on what the delta is of that option compared to the delta of the long option. As long as I still remain a positive delta, I maintain my bias while taking out risk on the trade. So I could have sold a little call vertical that's like 556, 559, got back 30 cents, got back 25 cents, and that would have taken out most of the risk of this trade. And lastly, I could do the same thing if the stock were to go down, and I would have only had 40 cents of risk per trade, and I was very confident I can get that back down to like 20 cents or like 10 cents, 15 cents, maybe even free trade if I really wanted to. And there was always going to be some extrinsic value of the FOMC option before the FOMC because the FOMC is a very volatile event. So that's why I thought there was basically no risk on this trade. Now let's see how this trade kind of panned out. So obviously on that day of, it kind of just ripped straight into my so it was right around here. So it kind of ripped up. Great. I was looking great. I was massively in profit here. But what was kind of interesting is that on Thursday, my short strike actually became in the money. So the entire position actually became slightly, it was basically delta neutral to a slightly negative delta trade because of the fact that there was $1 between my short strike and my long strike. And you'll see on Friday it actually became massively in the money here. But one fantastic thing I want to show you guys is if I go think back to say the just over the weekend pricing, and I put on the FOMC, the same trade, I can tell you that I was actually still in the money. I was still profitable on the trade, even though my short call was way in the money. It was like $2, $3 in the money. So I sell that, I buy this 560, and you can see that it was marked for around 47 cents. And I only paid 39 cents to get into this position. So I was still up on this trade, even though my short strike got breached on this trade. And that's because there's just so much volatility packed into the FOMC meeting. And you'll see that there is around a $7.7 expected move for the FOMC days before in the weekend. It still had 5.7 plus or minus expected move 1 minute going into the FOMC. So a whole weekend has passed, 2 entire trading days, plus 4 hours of another trading day has passed, and it still retained like 60-70% of its value. That's how well the FOMC preserves volatility in its option. So now let's take a look. Fast forward to Monday. I was like, okay, well, I can kind of use a pullback so my short calls can start decreasing in value. And so when it started gapping up, what I actually ended up doing was I ended up buying a call vertical. So this was at 10 o'clock in the morning. So 10 o'clock in the morning was right here. The market was kind of ripping up. So I was like, okay, well, I'm taking up too much negative delta in this position. Let's do something about it. So what I did was I bought for 6 of the 15 lots. What I did was I bought a call vertical for 74 cents to take out the risk of that of 6 out of 15 lots. And in order to finance at 74 cents, I sold 12 puts that were 35 cents to make the the debit kind of match up. And what this did was this added a lot of positive delta in the trade, where I was happy if the stock, so if SPY went up, I was happy because all my sold puts would have gone out worthless, and my now new 560 call vertical was going to increase in value. And if the market goes down, I was also happy because I need my 559s, which I still had 9 of them. I need those to go to 0. So it was kind of a win-win both ways for me. And so let's keep going. And you see that on the Wednesday, so on the Tuesday, so my game plan was, if my shorts are in the money on Tuesday, I will close out the entire position and not take any risk into FOMC. And what happens on Tuesday? So it gapped up, it actually ripped up higher. So during that rip, I got a little greedy and I sold some puts because I was just massively negative delta at that position, at that point. And I knew any puts that I sold underneath 559 was going to be like basically free, because you know I want those to go to 0, the calls to go to 0, and if the calls are not going to go to 0, the puts are definitely going to go to 0. So yeah, it ripped up, but thankfully I got this kind of like a jackknife down here, where the market kind of reverted back to 5600 on the SPX, which played out really well. And then when I was down here, I just started harvesting my gains. So first I sold 3 for $1.25. Remember, I paid 40 cents to get into this position, and then I sold another for $3.50, $3.35, and then I was putting on limit orders for $1.50, $1.40, and I couldn't get filled. And actually, this last little bit of rally at the end of the day really screwed me over. I could have gotten a lot more value on my position, but I ended up selling the rest of it at the market close for 82 cents, which is almost a 100% profit. And my calendars that I got for my adjustment, I made $1.88, and I only paid 40 cents to get into those. So just an absolutely fantastic trade all around. And this kind of shows the power of what you can do with options. It's not about just understanding, if the stock is going to go up or if the stock is going to go down. It's about buying what you think is worth more than it should be, and selling what you think it will go to 0. So I hope you like this trade. Please like and subscribe, and leave a comment on anything about this trade that you want to know more about. And I hope to see you in another video. Okay, bye.